For those of you navigating the investment landscape, especially in those high-growth sectors, you know the feeling, right? Trying to time the market, pick the winners, and, well, keep your cool when things get rocky. It can feel less like strategy and more like, I don't know, dodging bullets sometimes.
Absolutely. And that constant stress that need to be always watching, it can really wear you down. It undermines confidence. That's exactly why today we're focusing on this concept of peace of mind investing.
Mm-hmm.
And specifically, how a platform called Laze Q is actually designed to deliver that.
Right. And to really show how Laze Q works, especially for, let's say, sophisticated investors listening in, maybe you're in VC looking at fintech or managing a hedge fund or overseeing retirement plans, we're going deep. We're using a specific real-world case, LifeMD. That's ticker LFMD.
Mm-hmm. And for this, we're drawing on some materials, specifically titles like Laze Q Adaptive Intelligence in Volatile Markets, and also Laze Q Alpha Generation in Volatile Markets. So our mission today really is to understand how Laze Q's, let's call it unique approach, blending quantitative intelligence with machine learning, how that aims for, better returns and that deeper sense of security.
Okay, so Laze Q. At its core, you mentioned something called symbiotic quant intelligence, SQI. That sounds like the secret ingredient. Can you break that down for us? What makes SQI tick?
Yeah, think of SQI as a multi-layered system. The first layer is algorithmic intelligence. This is basically the powerhouse. It churns through massive amounts of market data, looking for patterns, correlations, things that human analysts just couldn't spot in real time. It's about finding those, hidden signals in all the market noise, like having super fast analysts decoding data streams constantly.
Okay, that makes sense. Using computers to handle the data flood. What about the quant part? How does that fit in?
So quant intelligence takes what the algorithms find and puts it through rigorous testing. We're talking advanced math, statistics, but crucially, it also folds in domain expertise input from experienced financial pros. And very importantly, there are feedback loops. The system learns from what works and what doesn't, constantly tweaking its strategies based on outcomes.
So it's not static. It learns and evolves and symbiotic. That suggests humans are still very much in the loop.
Exactly. That's symbiotic learning. It's all about the collaboration between human experts and the algorithms. The experts, the quants, the data scientists, they guide the system, set the big picture strategy, while the algorithms handle the optimization, finding the specific trade opportunities. It's this back and forth that makes it adaptive. And this all feeds into what they call the algorithmic discovery engine, which uses that algorithmic power plus reinforcement learning by trial and error, like an advanced AI, guided by the experts, to keep finding and refining investment strategies.
That sounds incredibly sophisticated. How does all this tech translate into, well, a real benefit for an investor, especially when it comes to risk?
Right. The payoff is what Laze Q calls intelligent risk mitigation. The system looks at multi-factor exposures, so not just stock price, but economic indicators, sector trends, market sentiment, the whole picture to really understand the risks. It uses non-directional adaptive strategies, meaning it doesn't need the market to go steadily up. It can find opportunities even when markets are choppy or going sideways. And critically, the execution is QI-based. It's algorithmic. It takes the emotion right out of trading decisions, which, as you know, can be a huge pitfall, especially when things get volatile. The key word is dynamic adaptation. It adjusts on the fly.
Okay, theory sounds great. But you mentioned the LFMD case study. That's where we see it in action, right? Tell us a bit about LifeMD itself.
Sure. LifeMD Inc. It's a U.S. telehealth company. They focus on direct-to-consumer healthcare services. Now, the company's history goes back, but the LifeMD brand and focus is more recent. They're right in that booming telehealth space. Huge projected growth there. Their services are pretty broad. Virtual doctor visits, chronic care, men's, women's health, dermatology, allergy stuff, even diagnostics and prescriptions.
So tapping into that demand for convenience, accessibility, maybe for people who find traditional healthcare costly or tricky to navigate, how do investors generally see LFMD?
Typically, it's viewed as, well, speculative growth play. High potential upside, definitely. But, and this is key, it's known for being volatile, which isn't unusual for companies growing fast, but maybe not yet consistently profitable, even if revenues look good. So analyst views are often, mixed. Reflects that uncertainty. And the stock price, well, it definitely lived up to that volatile reputation.
Right. Let's get into that volatility. What happened with LFMD's stock, say, mid-2024 to mid-2025? That makes it such a good test case for Laze Q.
Oh, it was quite a ride during that period. Over about 12 months, LFMD saw some really dramatic swings. It started around $7.77, climbed a bit to $8.40, then boom, a sharp fall down to $4.52. Then it rallied back, climbed up to $8.28, only to slide again, down to $4.12. And then it had this explosive rally all the way up to $11.53.
Wow. Okay, that's exactly the kind of action that would shake out a lot of investors. Makes it tough for simple buy and hold, and really dangerous if you let emotions drive your trades. So how did different strategies handle that roller coaster?
Good question. The case study looked at a few things. First, just a simple buy and hold over that volatile period. That actually delivered a decent return, 45.95% ROI. Respectable, given the swings.
Okay, not bad. But how did Laze Q do?
Well, this is where it gets interesting. The Laze Q baseline strategy, that's the one using just the disciplined, signal-driven algorithmic execution we talked about. Totally emotion-free database decisions. That baseline strategy achieved an ROI of 459.58%.
Whoa, hold on. 459% compared to 45 for buy and hold.
Yep, about 10 times the return.
That is, yeah, that really highlights the power of just taking the emotion out and using a systematic approach in that kind of market. But wasn't there another layer? The machine learning?
Exactly. So the Laze Q system with the machine learning layer integrated, that performed even better. It delivered an ROI of 585.60%.
Okay, so another significant jump from 460% up to nearly 590%. How did the machine learning make such a difference? What was it doing?
The ML layer was constantly dynamically adjusting the system's exposure to LFMD. It wasn't static. It got much better at fine-tuning the entry and exit points, really capitalizing on those short-term shifts and momentum changes. That ability to adapt, especially during those sharp drops and the quick recoveries that followed, that was crucial. It allowed the system to grab gains that a more rigid algorithm might have missed. Basically, adding the machine learning boosted the ROI by about 126% over just the baseline algorithm.
126% boost just from the ML layer. That's huge. The study also mentioned something about ROI analysis, delta ROI. What did that show?
Right, the ROI that looked at when those extra returns, the gains specifically from the machine learning layer, actually happened. And this is interesting, especially for sophisticated investors. Those spikes in extra return often came during those messy transitional phases in the market. You know, the periods of uncertainty where human investors, maybe using gut feelings or slightly old news, tend to hesitate or even sell out.
So the ML was finding opportunities precisely when humans might be most confused or fearful.
Exactly. These weren't just returns from riding a big wave up. They were opportunity-optimized bursts, driven by specific statistical signals the ML identified.
Okay, let's try and wrap our heads around the LFMD story then. You have this volatile high-growth stock, big challenge, buy and hold gets you, okay, a decent return. Laze Q's basic algorithm blows that away. And then adding machine learning on top turbocharges it even further by actively adapting to all the chaos. Is that about right?
That sums it up perfectly. The LFMD case is really a strong piece of evidence showing how Laze Q can generate superior returns, even in really tough, volatile environments like high-growth stocks. It highlights how making decisions based on data, algorithmically, and being able to adapt using ML can really pay off. It's a great example of that advanced risk mitigation and adaptive intelligence at work.
And that brings us back to the peace of mind investing idea, particularly for the audience we mentioned, accredited investors, VCs, hedge funds, pension managers. Because if the system is handling this volatility effectively, you're not constantly on edge, right? Not glued to the screen, second-guessing everything.
Precisely. The goal with Laze Q is to lift that burden of constant monitoring, of trying to interpret every news headline. Decisions are based on layers of quantitative signals. Execution's automatic, emotionless. It aims for what you might call effortless ROI, powered by embedded intelligence that's actually built for volatility, not scared of it.
It really drives home that point about adaptability being key in markets today. Things change so fast.
They really do. And for investors looking for a more robust way to handle that, especially in high potential but volatile areas, the LFMD example provides some pretty compelling food for thought.
So wrapping up this deep dive, it seems the LFMD case really does showcase Laze Q's potential, generating significant alpha even when the market's going wild. That's a strong pitch for sophisticated investors.
Absolutely. For accredited investors, for VCs scouting the future of finance tech, for hedge funds needing new alpha sources, and certainly for large funds managing long-term retirement money. Laze Q suggests a possible future direction for investing, where this blend of quant intelligence and machine learning delivers not just potentially better risk-adjusted returns, but also genuinely more peace of mind, more confidence.
It definitely leaves us with a question to ponder. Given how complex and frankly unpredictable markets seem to be getting, how might these kinds of adaptive intelligence platforms like Laze Q fundamentally change how you approach investing, how you pursue that often elusive goal of true peace of mind? Something to think about.